Welcome back to another issue of Learn to Trade with Tony, our day trading with Tony. And today I'm going to talk about the dead cat bounce and why it's significant, what it actually is, and more importantly, how to trade it. Before I do, though, just remember to hit that thumbs up button. If you haven't already, subscribe to the channel. And if you want to watch me trading all of these patterns and these methodologies and strategies live, hit the notification bell. You get to know every time I'm going to be trading live. Okay, without further ado, how do we trade the dead cat bounce? Hello, and welcome back to day trading with Tony. In this video, I'm going to talk about dead cat bounces and how to trade them. So, what is a dead cat bounce? Well, it's the idea. Let's just say you're stood on top of a building and you throw a cat off the top of the building and it hits the ground and it bounces and it heads right back down. Now, I don't know what the morbid history of this analogy is or why they chose a cat, but that's essentially the meaning of this. And essentially, what it means is that even though it bounces, it doesn't necessarily mean that it's ready to turn around and rally. It's just simply a natural reaction. And then you continue back towards the ground. Gravity eventually takes over. Now, there's also such a thing as an inverted dead cat bounce, which is the market rallying, then pulling back, and then going forward again. It's traded the same way. It's pretty much the same thing. Now, dead cat bounce, typically when people talk about it, they talk about it in longer time frames. But in our situation as day traders, we do see them occasionally. And what we want to see is we want to see it happen over the course of a couple of days because you really want momentum to pick up. So let's say you're looking at US Steel on the 15-minute chart that I've got pulled up here. You get involved on this day, and something happens to really send the market into a frenzy. See this massive volume spike. You can see I'm zoomed out here. We have a lot of selling that first day. The second day continues to sell, and the third day, etc. So eventually you get another gap down and start to rally. And the idea is you want to sell the rally. So there's a couple of different ways you can do this. You can look for an area of that perhaps previous support or resistance. And in this case, let's say that on the longer term chart, 31, 31.50, 32, this whole area has previously been resistance, and we broke above it. We pull back on the longer term charts. It does show the fact that so we broke through this area and we come back. We were tested, and then, well, that's one way to look at it. But what we really want to do is want to stack the odds in our favor as much as we can. What I like to do is on a gap down from the place it happens, draw Fibonacci. Just simply wait to there's a point where you have to kind of use the confluence of factors. And in this case, you know, like I said, there were support and resistance. Here's an area between 31 and 32 that's attracted a lot of attention in the past. It's also a box between the 38.2 and Fibonacci and the 50 Fibonacci retracement level. You can see it was in fact a selling opportunity. So what you're doing is, as it rallies like this, you recognize that there was a recent high, but there's a lot of noise here, and you could have a lot of reason to think that this could cause some trouble. Certainly the volume spiked here, so you're looking at a tradable pattern. You're looking for a tradable pattern in this area. You simply want to wait until it appears. There's nothing magical about trading these things, because what happens is, you know, somebody who is long of this stock, this happens. They're trying to mitigate the damage, so they get trapped and they want to get out. They want to get out as quickly as they can on a bounce because it gives them the opportunity to recover some of those massive losses. In the stock market, you know, these do happen occasionally. A lot of times it comes down to earnings, though. So, for example, This market here is Disney, and this is a little bit more liquid, so you don't see it as much, but clearly, like so, you can see that we gap lower and we turned around and spiked higher. We rallied and we pulled back. So if you've missed this move and it was a nice volume again, you could look for previous support and resistance. That's one factor to put in. And keep in mind that it's right here at about 150.50 or so. On this move, you could also do a fib, and draw that. So you're right in this area. What you're looking for, a supported buying opportunity, and we did in fact gap higher on this day. And that was a signal to go long. Now, like with all things technical analysis related, higher timeframes tend to be more reliable. It certainly means much more. You know, when I pull up the daily chart, this is a dead cat bounce. You could draw, let's see, it started basically from here. So you could draw this, hang on. It started from here. You can draw this and you can see that around the 61.8 Fibonacci retracement level off of resistance on the daily chart. And it's an area where we've seen traders go back and forth a couple of different times. So with that candle and the gap lower, that was a clear trading signal. You got in about 102.5, and you know it goes all the way down to 90. So it does work in all time frames. You clearly want it to line up with resistance and support and fibs. It makes for a nice, you know, meeting of the two forces. You don't always get a re-entry, so that's a bit of a problem sometimes. It's just a runaway market, and then you just trade it as a gap. But really, it's a little bit of an art. But like all things, you want a couple of things to line up. And this is probably one of the trickier ways to trade. Okay, so try it out and happy trading.